Morning, everyone. Welcome to the Multifamily Investor Nation webinar. Our topic today is navigating multifamily refinances in today's market. It should be interesting. So if you could drop in the chat, let us know where you're joining from, what part of the country. Nashville. All right, we have a property over there. It's a great market. They have a lot of supply, but a lot of in-migration as well. Maryland. Welcome. We'll give it a few more minutes here for folks to get on. Also, if you have any questions or any properties you're working on a refinance or purchase, or any multifamily questions, I deal a lot with debt, insurance, asset management, all kind of fun stuff related to multifamily. So happy to share any questions you may have. Denver. Hey, Chris, I was out there a few months ago. All right. Well, again, my name is Ed Gilmer. I'm the Director of Capital Markets with PassiveInvesting.com. Also handle our asset management, multifamily insurance, and capital markets for several other asset classes. I appreciate your time getting on here today. As all of my webinars are electronic and interactive, so feel free to ask questions, raise your hand. Happy to address whatever issues we have here. The topic today is refinances and multifamily. Tough topic given the markets, given property performances the last couple of years, treasuries day to day, not helping anybody out now. I think the 10-year this morning is about 4.52, down from where it was a couple weeks ago, but significantly up from where it was 6 months or a year ago. We had a good stretch back in August, September last year on the treasuries. So the points we're going to go over today are going over refinance options. We're going to look at getting your expectations in line with current interest rates, breaking down loan terms for better clarity, and crafting a game plan for future success. Kind of looking at your expected hold period and lining up your debt accordingly. Like I mentioned, refinances are tough in this market. A lot of properties that were bought 18, 24 months ago, 3 or 4 years ago, were purchased kind of at a higher valuation. COVID drove rents up for 2020, 21, 22. So a lot of purchases were made at a high valuation. Across the country, a lot of multifamily operators are having to do cash in refi, which is the opposite of cash out refi, which is much better. But cash in refi is kind of getting loans sized for current debt parameters, be it a debt yield, a DSC, loan to value hurdles. All lenders have different metrics they're working with there. As always, the two best options traditionally for a long-term hold, 5+ years, would be your agencies, Freddie, Fannie, and HUD. If you have the time to work on HUD loans take about 6 to 8 months from start to finish. And you can't lock in the rate till a bit down the road, 2 to 3 months down the road, traditionally. So a lot of exposure there. Freddie and Fannie loans can get done in 2 to 3 months, best case. And you can lock in your rate there about a week or two in. So at least current treasuries kind of give you more of a ballpark of where the rates are or will be. I've seen treasury spreads they've come in a bit. They were about 180 to 210 basis points over the 5 or 10-year treasury last couple of years. I've seen them as low as 150 over in a couple deals, couple markets. 150 over the 5 years, 5.8% or so. So not terrible. 150 over the 10 years, about 6 or hair over 6%. So historically, that's pretty good. If you look at the last 2 to 3 years, maybe not the best rate, but 5.8 to 6%. You get a little bit of interest only there. Decent leverage, not a bad option for a refinance. So you have your agency refis. You have banks are kind of getting back into it. Bank lenders were out for a while, especially for construction loans. I've heard from a couple banks that we have relationships with that they're kind of open to either construction loans at a lower loan to value or refinances in the right market for the right size deal for the right sponsor or guarantors. Typically, bank loans are going to have personal guarantees of some sort, whereas your Freddie and Fannie are not personally guaranteed, non-recourse. Life insurance companies have kind of been a little bit lower leverage loans recently. I love life co loans. A lot of those you get 5 to 7 years fixed at a reasonable rate. But right now, those proceeds are sized into about 50 to 55% loan to value, whereas historically they were 65 to 70% loan to value. I like the idea of a CMBS loan. Right now, the proceeds again are kind of tight in about the 60% range. And again, Freddie or Fannie are typically your best options for leverage and rate. If you have an affordable deal, you can get a few more basis points off there. Aligning expectations with current market rates is a big one. 3.5 years ago, you'd be looking at a 3.5% fixed rate with an agency deal on a 5 or 10 year term. Some of those deals are coming to market with assumable debt. Maybe you get a couple more years of interest only and then some amortization years at a below market rate. Again, that deal today is 5.8 to 6% loan. So if you can get a deal that's 3.5, 4.5% interest only, even if it's amortizing, you might come out ahead. I've seen a premium on deals trading with in-place debt below market rates. And part of that, I would say, is kind of buying the rate down. So there's some value created there. I think I saw a question pop up and go away. Who do you contact for agency loans? I would recommend a debt broker. You could look up multifamily debt broker. We work with a lot of them. There's a lot of good ones. I would probably lean towards one of the bigger ones. There's plenty of them out there. So another question is an agency 2 to 4 unit purchase loan recourse. 2 to 4, I would probably do a bank loan. And another question, can I share some context? I'll put together a list and maybe you can share on the next webinar. I don't want to give you 1 or 2. I'd really give you 5 to 10 and share those. But on a 2 to 4 unit, you could do, FHA is an option, bank financing is an option. You're going to get better leverage. And if you're living in, I think to Cynthia's question, if you're living in one of those units, that's an even better deal. Investment wise, you get much better rate. The typical cost to use a debt broker for an agency loan, a lot of them start at a 1% origination fee, and that's just going to the debt broker, the broker's fee. Banks and agencies have their own origination fees, and a lot of those start at 1% too. So if you're doing a $10 million loan with a 1% lender fee and a 1% bank fee, that's some big money up front. You can negotiate the lender origination fee. It's flexible. You can try to negotiate the spread on some loans. It's push and pull, right? So if you get higher leverage and a bit higher spread, maybe they're not going to come down on the origination fee. You got to know where to push. Everybody has different buttons. If you want, the lowest rate possible, maybe you pay a higher origination fee. But with the debt broker, the bigger the loan, the lower the fee can be. We've had a lot of success using the same debt broker for multiple deals. They know there's some more business coming their way. Maybe they go from a 1% fee to 50 basis points, perhaps 45 to 50 basis points on the best deal. And if you're doing a $50 million loan, $100 million loan, that can be 40 to 50 basis points. You can kind of squeeze it because 50 basis points on a $50 million deal is still what is that, 250K? Pretty good day for whatever work is involved with that. So other costs associated, a lot of times you put up money for them to use the third parties. They have to go do reports, appraisals. That can be 25K, 50K, 100K based on the lender. We're looking at a couple deals now, refinancing some deals, and they wanted 100K put up to use towards their cost. If you know, the idea there is if you walk away, they're not out of pocket any cost, and if you continue with the loan, that would apply towards your closing. So not a sunk cost, just more of an upfront deposit on third party reports. But good question. Another thing that's kind of shifted in the market is loan terms. Typically, your 5 and 10-year agency deals are kind of your bread and butter. With a 10-year deal, you maybe get 5 years interest only, 5 years amortizing at a fixed rate. On a 5-year deal, you maybe get 1 or 2 years interest only, 3 or 4 years amortizing. So and 7's a good option too. I mean, 7's kind of right in there. You get 2 to 3 years IO, 3 to 4 years of amortization. Your rate's going to be similar. So the downside to agency deals, if you don't plan on holding it for the full term, 5, 7, or 10 years, something else you can negotiate is the defeasance, the prepay, or the exit fee. Kind of different words for the same thing. They sell those off as bonds, the income streams. So they have people that are used to the income streams. And if you sell the deal in 2 years, there's a fat fee there, defeasance, prepay, whatever you want to call it, exit fee. You can negotiate that a little bit. On a 5-year deal, a lot of the prepay fees stop at 4.5 years. So if you hold the deal 4.5 years, maybe the last 6 months is open. That's the terminology kind of used. Otherwise, it's a factor of the remaining payments that the investor would have received that bought the bond. So that is the downside to agencies. Whereas bridge debt, life codes, and banks can be more flexible. A lot of time, bank prepays are like 3, 2, 1 step downs, right? If you do a 5-year bank deal, it's going to be 3% prepay year 1, 2% prepay year 2, 1% year 3, and nothing years 4 and 5. It's a lot more palatable. Life co deals, again, negotiable. Anytime you get a term sheet, I would go through it, kind of pick your top 2 or 3 points, be it proceeds, maybe you want max proceeds, maybe you want the lowest rate, the lowest spread, or if you're more sensitive to cash up front, maybe you want a lower origination fee and you can do a little bit higher spread. There's push and pulls. You have to know when to push and pull. You don't want to be a repeat borrower to lenders when you're just beating them up on all these things. They get frustrated. The banks kind of have a threshold of amount they can flex. I typically let it go back and forth once or twice. Anything beyond that, you're just becoming a pain to them, and they're kind of going to walk away from the deal. So kind of know the relationship, know and learn what you can and can't push on, what buttons to push on for a refi. Max proceeds is always a big one, especially given the current market. And spread is a pretty big one. A lot of times, once I get those 2 ironed out, I'll wait to beat up the lender or negotiate with the lender, and the broker on their fees is the last one. Kind of say, hey, we're pretty much there on this deal. I need your fee to come down from 1% to 65 basis points or 75 basis points. And you kind of say, hey, if we can get that across the finish line, you cut that, we've got a deal, right? You make money, we get a loan, everybody's happy. Let's see, another question here. Max proceeds. So let's just say you had a apartment complex worth $10 million, right? Traditionally, the max loan you could get would be 70 to 75%. In today's market, a lot of deals are limited by the cash flows. So DSCR restricted. Maybe it's not making enough net income to support a loan of 70, 75%. It likely is not. So most of those deals are limited DSCR limited, debt service coverage ratio limited. If you bought the deal for $10 million 3 years ago, 2 years ago, maybe it's worth $8 or $9 million now. So your loan to value may be a bit lower. And the other metric would be debt yields. You have debt yield, loan to value, and DSCR coverage. Debt yield is just NOI over loan amount. So 12-month NOI over loan amount. Typically, lenders look for 8, 9, 10% debt yields. It's kind of a ballpark sizing. But the last point here, before any additional questions, crafting a game plan for future success. What you don't want to do is go lock in a 10-year loan at 6%, right? And then in 2 or 3 years, you want to sell the deal. Let's say treasuries have dropped. The current rates at the time are 4%. You're going to have a tough time selling that deal because the buyer's going to have to either assume the debt above market, which is not good, or you're going to have significant prepay. So what I would recommend is based on your market forecast. Nobody knows for sure where rates are going to be in a couple of years, but they're not going to be where they are now. I'll tell you that. So I would keep my trajectory in the 3 to 5 year range. 3-year deal with maybe 1 year interest only, 5-year deal, 1 or 2 years, and then refi whenever you can, whenever rates shake out. Hopefully they're lower at some point in the next 3 to 5 years than they are today. I think it's a pretty reasonable forecast. Again, could be wrong. You're not locked into too long of a rate that could potentially be above market. You don't want to be at I saw a deal last year. I think it had 6.1% debt, and at the time, the market rate was like 5.25. So you're already behind the 8 ball getting started on that deal with above market debt. Needless to say, that deal did not trade. So you're going to get stuck with it. The other option there would be you could do a supplemental. It's kind of like a cash out refi. You go back to the lender, a year or two later on a Freddie or Fannie loan, say, hey, NOI has grown here. Our DSCR and debt yield are much better. Can I get some more proceeds? You can, in a traditional market, tap into some additional equity created through NOI growth. After, there's timing too. If you have a 5-year deal, I think you have to do it the first year or two. With a 10-year deal, you have the first 3 or 4 or 5 years to tap into additional proceeds as a supplemental. If you're able to have significant NOI growth, so you could go back and say, hey, the deal sizes up for another $1 million, $2 million cash out, and take that out, put it towards the property, redistribute to investors, or whatever you want to do there. So I'm going to take a minute here. Any questions on refis? Any questions on acquisitions or just multifamily markets in general? Let's see Cynthia's question. Is it still realistic for me to use 50% of income as expenses unless seller financials are higher? This is all over the place. I would take seller financials and kind of run through them item by item. They might have a bad insurance price. They might have significantly higher repairs and maintenance. They might have low repairs and maintenance. Maybe they're doing it all themselves. Your earlier question on a 2 to 4 unit, maybe they're paying a property management fee. Maybe you're not paying one. So kind of run it through your model. See what expenses are legit. And taxes, probably what they're going to be, right? You assume insurance is close, easy to get a quote on that. Repairs and maintenance, you can kind of use some industry numbers for that. You do a little digging there. I would certainly not use anything a seller ever gives you as fact. So I'll always question, ask for support or where they got it from, but then use all your numbers. But on a larger multifamily deal, expenses should be below 50% of income. On a 2 to 4 unit, could be a bit different. So, all right. Any other multifamily questions relating to refinances, debt, acquisitions, market questions in general? Another thing, we were talking to some brokers in Florida a couple of days ago, and to kind of give us an outlook on the Central Florida market. They were, and this is across the country, Nashville, a few other markets as well. Due to construction loans being hard to get the last couple of years, there's not a lot of multifamily deliveries coming online the second half of 2025 on into 26. So our forecast is you're going to see some rent stabilization due to supply constraints the back half of 25 into 26. A lot of the oversupply in 2024, 25, first half of the year is being absorbed in the bigger markets. Nashville's, oversupplied. Orlando was oversupplied, but the deliveries the first half of this year and the second half of this year are lower than traditional. So lower deliveries with a stabilized in-migration means rent should grow, all else equal. That's the question. Is it a good time to sell multifamily or hold it for a few more years? That's a broad question. Sales volumes are down across the board for a lot of reasons. Values are not where they were a couple of years ago. One related to treasuries. Higher treasuries mean lower values. The cost of debt's higher. When the cost of debt's higher, people can afford as much. Purchase power goes down. If you're able to hold for, I think, another 12 months plus, reasonably, assuming no, macroeconomic event, and reasonably lower debt, I think you would be a better time to hold and look at a future sale. Are loans hard to get in the Texas tertiary market? Across the board, generally speaking, loans are harder to get. Lenders are looking at more at borrowers or sponsors' liquidity, net worth, experience. It depends on the size deal as well. If you're doing a 2 to 4 unit, probably pretty easy to get. Go to your local bank, find a lender, knock it out. If you're, okay, here, 250 units, decent size deal, depending on the age of that deal. Not a lot of lenders have capital they need to deploy. They're being selective as to the borrowers and the markets. We tend to focus on primary, maybe some secondary markets. A larger property in a tertiary market, it could certainly be a good play, probably getting a lower basis there, less competition. Competition is a big one on rent growth. So if you see a path to growing rents in a tertiary market with limited competition, I think that could be a great property to look into. So a lot of the institutional capital, the Wall Street capital, a lot of those, they're buying, your Atlanta, Charlotte, Raleigh, Jacksonville, Miami properties, Houston, Dallas, etc. And you get into the secondary markets, the mid-major metros, kind of like the Myrtle Beaches, the Savannahs, maybe Raleigh, Augusta, Georgia. There's less competition, and when you get too small, you kind of get to be a big fish in a small pond. Might be a bit harder to dispose of in the right market. But so I would kind of look in the small, major to larger secondary markets is a good markets. They get less competition from institutional investors. So we were looking at some deals last year. I think the bidder pools were 35 to 40 bidders in a major metro. Whereas if that deal was on the market this year, I'd be surprised if it's 5 bidders. Prices aren't getting pushed up as much. And a lot of buyers now are cash buyers. And if they're cash buyers to hold, or they're buying in cash and refinancing later, A lot of funds, like I said earlier, have the capital, the liquidity to purchase in cash and are looking to put debt on once rates settle out a bit lower. So let's see, one comment here. In loan assumption option, can the seller pay yield maintenance? Absolutely. They never want to. A lot of times the deal is, I've seen different prices. Let's say a deal is $50 million if you assume the debt. And if you don't assume the debt, they're going to ask $52 million, you know? So they're trying to make up their number, but a seller's in-place debt should not be a buyer's expense. The seller should have to eat it, in my opinion. I would not pay more for a deal to make up bad debt. The flip side, I would pay more for a deal with lower than market debt. So if it has 4% fixed rate debt with a, a reasonable remaining term on there, that's of higher value on a per door basis than a deal today you're buying at market rate. So, and the second half of that question, can that structure be negotiated? Not a lot of negotiation in that. They're kind of solving for remaining cash flows or expected cash flows to bond investors. Where you could have some success is maybe the seller has a $2 million defeasance, right? You could say, hey, you pay half, I pay half. Maybe you pay 3/4, I'll pay a little bit. And negotiating with the seller. The seller is going to have to pay it if you don't assume the loan. But I would not want to assume a loan above market rate, significantly above market rate. Again, today's rates are 5.8 to 6%, given a 150 spread over treasuries. That spread does ebb and flow, so it can be closer to 2%. Treasuries can go down 20 basis points tomorrow. Who knows? So we live in a very volatile market as far as treasuries go. The 10 years 453 right now. It's gone up since we've been on this call. So you never know. The position you want to be in to lock would be to get your application going with a lender and then wait on a good treasury day. Once you're approved to lock your rate, wait to pull the trigger till you find a day that works with you. Rates can be up 10, 20 basis points in a matter of a couple of days or weeks. So if you could catch a good day, lock in a good rate, and just live with it. We had a drop late, like I said, August or September of last year. The downside there is if you locked in your rate a week before, you were 30, 40 basis points above market. Nothing you can do about it. You could always cancel. You can't do another loan with that lender for, I want to say like 6 months on that deal. So maybe not the best idea, but I appreciate the questions. If there, let's see, we got one more here. I'm gonna make this the last question. So we focus in the Sun Belt states, kind of North Carolina, Tennessee, Georgia, Florida, over to Texas. Not so much Alabama, Mississippi, Louisiana, but and most investors are focused on Sun Belt states. Some are kind of bigger over in Arizona, New Mexico. Texas is a big market. Texas has a lot of tax challenges. Florida is tough right now. Florida has a lot of insurance challenges. And insurance rates were just starting to come down later last year in certain markets. And I think with the hurricanes that happened, the fires in California that happened, I'm afraid the insurance market is going to get disjointed even further going into 25. So the tough thing is 50% of the country lives within 50 miles of the coast, right? So the whole East Coast, Gulf, West Coast, but that's where people want to be. But that's also where your insurance rates are higher. So price out insurance early on a deal, that can be a big number. I mean, especially if you're looking at multiple deals in one market. I mean, maybe this one's in a flood zone, this one's not. Those are big numbers. We have had success getting a property out of a flood zone recently. So it all depends. Why is Alabama not on the radar? Is not that it's not. There's some good markets there, secondary, kind of larger tertiary markets. Tuscaloosa has a lot of big employers, kind of bringing a lot of talent, a lot of high-paying jobs to the area. I think there's some good markets to look at in Alabama for a reasonably sized multifamily deal. It's just not one we're currently in or looking at. So, good questions. Well, I appreciate everyone's time. Hope you have a nice rest of your Tuesday, and I'll catch you next time. Thank you.